We're not going to see $2,000 gold again or $25 silver again. We're in a completely different price environment, and which is setting itself up for much higher prices in the future. But we need to just kind of have this market cool down a little bit into the summer months. And it's often April, May, June are quiet anyways, so it's pretty common. So that's what I'm expecting.
Bank of America just made one of the boldest silver price calls on Wall Street. Michael Widmer, the bank's head of metals research, projects silver could reach anywhere between $135 and $309 per ounce before the end of 2026. That's a low call of $135 and a high of $309. This is a real thing.
The precious metals market is entering a very different phase, one that no longer resembles the price behavior investors were used to over the past decade. What once served as resistance levels may now become distant reference points as structural forces begin to reshape the trajectories of both gold and silver. The current environment suggests that the floor has shifted higher, and the long-term trend is no longer defined by suppression, but by expansion. Keithneumeyer, a leading voice in the silver mining industry, and Rafi Farber, a strong advocate for sound money principles, explain that markets are transitioning into a new price regime. Neumeyer emphasizes that we are unlikely to revisit $2,000 gold or $25 silver, pointing instead to a structurally higher base forming beneath current prices. Farber reinforces this view by highlighting the monetary dynamics driving capital into hard assets. At the same time, projections are becoming more aggressive. Institutional forecasts are now pointing to potential silver prices between $135 and $309, suggesting that the upside may be far greater than most investors expect. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I'm a big believer in charts, and I like the way the charts are looking. We did have this parabolic move up to the 120 range, and it had to correct, and it had a pretty violent correction, as we all know. And now it's kind of leveling out here, and people need to get used to this new pricing, regime that we're in. We're not going to see $2,000 gold again or $25 silver again. We're in a completely different price environment, and which is setting itself up for much higher prices in the future. But we need to just kind of have this market cool down a little bit into the summer months. And it's often April, May, June are quiet anyways, so it's pretty common. So that's what I'm expecting. What took us, I think, to the levels that we're at now is very much industrial driven. With silver, being deemed a critical metal, and then people waking up to the fact you start bringing in hedge funds and investors, and that final move from the 90 range up to the 120 range was all short covering. People were in a lot of pain, as you can imagine, on the long side of that point, and then or the short side, pardon me. And then everyone on the way down got hurt on the downside. So I'm not sure who made money on that big rally, but I can assure you not too many people did. So it came completely unexpected. But as I'm thinking this is just the beginning, and we're going to see much higher prices in the years to come. But we may need to wait it out here 2028 to through 2030. I've said $5,000 gold and triple digit silver, but we hit both much sooner than I would have expected. We haven't purposely been quiet about it. We just wanted to, when we made a statement, we wanted to, make a somewhat final statement on what the go-ahead plan with Jarrett was. And it took us a while to get there. And Gatos stood in the way. We had our whole team getting Gatos dealt with, purchased and integrated. And that's a lot of effort for the team. And it's the same group that would, be working, with Jarrett Canyon. So, once Gatos got smoothly integrated, we decided to focus on Jarrett, and we started running numbers and got an engineering firm consultant come in and do some work for us. And it's very gold price sensitive. So we went from 3.5 million ounces gold at 5.4 grams, I think it was, to that was at $1,600 gold, and at $3,300 gold, we're at about 8.3 million ounces of gold at about a 4 gram cutoff. So the resource has gone up, and that's because of drilling over the last 2 years. So it's now ready. So we're now ordering equipment. It'll all be self-mining. We're buying our own fleet. Nothing will be rented or leased or pardon me, rented. And all our employees will be direct employees. They won't be contractors like in the prior model, how it was run previously. So it'll be pretty exciting, and we should get it up and running by third quarter 2027. Our guys, when we bought it, we knew there was flaws, and we recognized many of them that occurred over the time we were operating, and many of which we expected to occur. But the gold price was not cooperating, and at $1,600 gold, our all-in sustaining costs at the time were $2,400. We ran it like that for quite some time, and we're burning through cash, and the November of that year, 2022, I guess it was actually really good. We almost broke even that month, and we were pretty optimistic that we're getting headway. And then in December of 2022, it went down to minus 35 and stayed there for 2 weeks, and the entire plant froze up, and all the pipes burst, and it was quite an amazing situation. It was apparently a 140-year weather event or something like that in this part of the world, and the whole west coast of North America got affected, California and so on and so forth. But anyways, so that was pretty bad. So that was kind of the straw that was the last straw, and I pulled the plug on it in February of 2023, and it's been shut down ever since. So we know the asset, we know it's tainted, but we also know at the same time we can get it back up and running. Oh, I think it's we ended off Q4 very strongly, and that kind of went into Q1 as well. And some grades were higher than we expected. Winkatata is doing well. All the mines are doing actually quite well. It's nice to have 4 mines operating, and they're all operating at or slightly above budget. It makes a huge difference, and we operated above 5% above budget in Q1, and we're looking at around the same for Q2. Our next goal is to get through the 50 million ounce silver equivalent threshold. It took us 23 years to get to 30 million, and I think we can get up to 50 million within the next 10 years. I think that's a reasonable goal, and that's what we're trying to shoot for. And it's going to take 2 things. It'll take M&A, successful M&A, and also successful drilling and mill expansions. That's the 2 kind of legs of the business that we're very much focused on.
Returning to the short-term outlook, it's important to remember that markets that move strongly often require periods of consolidation. The current expectation is for a cooling phase during the quieter summer months. Historically, April through June tends to bring reduced volatility in precious metals, allowing the market to reset before the next leg higher. This pause should not be mistaken for weakness. Instead, it reflects a normalization after a strong upward move, where momentum is digested and new support levels are established. The broader trend remains intact, supported by macroeconomic pressures, including currency debasement and persistent inflationary forces. Building on these technical and macro observations, what stands out is the growing alignment between technical structure and macro fundamentals. Chart patterns are increasingly pointing toward continuation, not reversal. This suggests that once consolidation completes, the next upward move could be more powerful and sustained. Let's get back to the interview.
Bank of America predicts triple-digit silver this year. This is actually from February 28th, and it's making the rounds now. I'm not sure why, but from the street, we have Bank of America revamped silver stock price target for 2026 by Hillary Remy. Bank of America just made one of the boldest silver price calls on Wall Street. Michael Widmer, the bank's head of metals research, projects silver could reach anywhere between $135 and $309 per ounce before the end of 2026. That's a low call of $135 and a high of $309. This is a real thing. This isn't gold or silver bugs that have suddenly invaded Bank of America. This is a normie guy, as much as I can tell. The $135 base case assumes a natural bull market continuation without a squeeze or panic buying. The $309 target is a different animal. It would need a liquidity event, a delivery squeeze, or a surge in physical demand that overwhelms paper markets, all of which could very easily happen this year, and I think will. One of them will, or maybe both of them will, or all three of them, however many there are. I don't know. On that note, we have another panic call, not quite panic, but he's saying prepare for panic, by Henry Paulson, aka Hank Paulson, the Secretary of the Secretary of the Treasury during the 2008 financial crisis, who basically bailed out everything under George W. Bush. So he says, with regard to any breakdown in the $31 trillion market for U.S. government debt, Paulson said that would pose a different case from the financial crisis he dealt with while the Treasury's helm 2 decades ago. And this is from CNBC, by the way. As bad as it was, he says, about the 2008 financial crisis, the government had fiscal firepower to address the credit meltdown. You can come in and clean up the mess, but in the event of a U.S. public debt crisis, when you hit the wall and you're trying to issue treasuries and the Fed is the only buyer and the prices of the treasuries are going down and interest rates are up, that's a dangerous thing. You know what it is, Hank? It's called the end game, and there's nothing you can do to stop it. He says we need an emergency break the glass plan for when this happens. As for commentators that are saying that silver is draining from the Comex, this is technically true, but it's also not so much true. It depends on context. I'm not criticizing these people. I'm just saying to broaden out the views here and understand what they're saying in the context of what's happening since the 1970s, or at least the 1990s. So we see here silver draining from the Comex. Yes, that's true in the sense that we were at about 530 million ounces, and now we're at 316 million ounces. So that's over 200 million ounces drained out in just a few months. That's all true. But when it comes to context and how high are silver inventories at the Comex, they're still pretty damn high. Higher than they were at the highs in the 1990s. We're very near the recent highs of 2021, slightly below them. But if we look at the registered stocks by themselves, we are right near, and this is as far back as the data for strictly registered silver supplies go, we're near what highs were before 2021, right? 80 million ounces, 79.28 million ounces. This was around the highs that were seen from 2000 to 2020. There's no shortage here. There's still plenty of silver, plenty of registered silver for sale on the Comex. And while some of it is leaving, these things go in waves. So I won't be paying much attention to this until we get somewhere around these levels in 2023 or 2016, and that is critically low. We're still plenty of space away from that. We'll see if we get there, and I will keep my eye open. Is gold really draining from the Comex? Well, same story here. This is the total gold supply, both registered and eligible, meaning for sale and not for sale, 29.44 million ounces, total Comex gold stockpile. So we're at just below 30 million ounces. And if we go back 2005, I could go back to all the 1974 all the way, but numbers didn't really change much from 1974 until about 2020. So we see here that we're still at very high gold supply here on the Comex, and yes, it has drained out from about 45 million to 30 million in about a year and a half, but that's happened before, and it happened from 2020 to about 2025. So we still got plenty of room here, and there's no critical mass or critical situation on the Comex in gold supplies at all. But there is something happening in the futures market that could pick up some volume and some open interest. The margin requirements are going down. For the gold contract, we see the current initial margin requirements are 7.7%, and they're going down to 6.6%. That's a meaningful move down. Also for silver, we see they're at 15.4% and going down today, Friday, to 12.1%. So this will increase leverage on the Comex trading platform and will draw in more traders as they can afford to spend more money on contracts because margin requirements are lower. We'll see what that does to the market if it wakes it up a little bit. Silver is still in its lowest activity since 2008. I mean trading activity on the silver futures market in New York. We see here that we are at 114. We're actually at 112,700 contracts because this is a day behind. So 112,000. This is basically a low going back to 2012. And before that, 2008, 2009. And we see here that during these times, there are some extreme things going on in the financial system. In 2011, obviously, we were at the highs in gold. So something big is going on in the silver market, though. It's still trading very, very quietly right now. It's just that nobody knows exactly why and what is happening. But whatever it is, it's big. And there is a potential to fall below 100,000 contracts. Before we go into this chart, I'm just going to go back here for a second. This 100,000 line, you can see I drew a black line just above it to where we are now, but 100,000, that's below this 2011 low. And the only time we were below 100,000 since 2008, since the financial crisis, was the financial crisis itself. We've never gone that low since then. But if we do, here's how it would happen, right? So we have the May contract delivering on April 29th, I believe. I think that's a Wednesday. That's Wednesday of next week, this coming Wednesday. And we see that you have to roll over if you don't want to take or make delivery. You got to roll over for May. The contracts are closing out for May because people don't want to either take or make delivery of silver and would rather roll over into the next position. So 4,000 have cleared out yesterday, and only 2,500 have been bought or have been established since yesterday. So also yesterday. So a loss of 4,000, a gain of 2,000. That means only half of them, or slightly more than half of these longs and shorts, have moved over to July. So if that continues, we could see about half of these 34,000 being wiped out, being closed out for good without rolling over. Half of 34,000 is about 17,000, let's say 15,000, 14,000, whatever. We're now at 112,000. So we could see a move below 100,000 contracts, which we have not seen since the 2008 financial crisis.
Looking ahead from this combined perspective, the implications of this shift are significant. If the market is indeed transitioning into a higher pricing regime, then current levels may represent early positioning rather than late-stage entry. The idea that gold and silver will not revisit previous lows signals a fundamental change in how these assets are being valued globally. Silver, in particular, stands out due to its dual role as both a monetary and industrial metal. With rising demand from sectors like energy and technology, combined with tightening supply conditions, the pressure on prices could intensify rapidly. When this aligns with monetary demand, the resulting moves can be explosive. At the same time, institutional forecasts projecting triple-digit silver prices highlight just how underpriced the metal may currently be. These projections are not driven solely by speculation, but by a recognition of structural imbalances building within the market. For investors, the key takeaway is patience and positioning. Periods of consolidation are part of the process, not the end of it. The larger trend appears to be unfolding in stages, each one setting the foundation for the next. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.